Ladies and gentlemen, Happy New Year. It is a great honor to have the high-tech strategy, Mr. Fred Hickey, here for our Q1 advisory board. Fred, thank you very much for taking the time.
Oh, my pleasure. Glad to be with you.
Welcome, Fred.
Thank
Mark
you.
is here as well. Hi, Mark. We do miss Jim Rickards. He's currently fine-tuning and editing his new book. So Jim, all the best for the final part of publishing the book. Yeah, I mean it's exciting times. Today's the 25th of January, and we are finally seeing some volatility in financial markets again. Very interesting developments in the tech space, but also in the commodity space, in the gold space, obviously, cryptos, and yeah, I look forward to discussing all those topics today with Fred. First of all, I briefly want to introduce you, Fred. I think most people are familiar with you anyways, but I'll briefly read your biography. So if I can find it, there we go. So Fred is the editor of the newsletter, The High-Tech Strategist, which he has published monthly for the past 35 years. So you started writing when you were like 10 or 15, right?
Yeah, I'm getting a little old.
The newsletter focuses on general macro issues, technology, and precious metals. He was a member of the renowned Barron's Roundtable for a decade, and prior to founding the newsletter, he was employed by General Telephone and Electronics in various financial roles for over 10 years. Fred graduated from the University of Notre Dame with a degree in business administration and accounting, and he resides with his wife Kathy in their homes in New Hampshire and Playa Hermosa, Costa Rica, where you currently are.
And glad to be here.
Excellent. So just for the beginning, just some housekeeping from our side before we jump into the discussion. As many of you know, we published right before Christmas, we published our new Bitcoin chart book about the halvening cycle, where we basically already said that it seems that there's some downside in the crypto space. Then brand new, we basically divided our YouTube effort. So we've got one channel now for all our German content, and then we've got another channel for all English content. Then on our In Gold We Trust webpage, we've got a brand new section with charts that we think are most interesting. So we show real interest rates. We're showing lots of different ratios. We're showing a table of gold in various currencies. We've got some charts on the mining space. So have a look at our brand new In Gold We Trust webpage. Then we just launched a new share class for one of our funds that basically distributes all the income that we get from writing options in the Bitcoin space. I think last year, Mark, it was like 15%, if I'm right.
Right.
So we're distributing this premium income. Perhaps we can talk about the options market with Fred later on, because he's also using quite a lot of options for his investing technique. And then obviously we're already working on the new In Gold We Trust report that will be published, I think, on 24th of May, we will publish, as usually, a preview chart book of the In Gold We Trust report, probably beginning of March. And now that we have a German, an English, and a Mandarin version of the In Gold We Trust report, this year we will also publish a Spanish edition of the report. So we are really going global now with the report. That's it from our side, Mark. What else? What did I miss?
I think you got everything. Thanks for the introduction. Let's jump into the discussion.
Absolutely. Absolutely. You want to go first, Mark?
Yeah, happy to do so. So welcome once more, Fred. Thanks for taking the time. As far as I know, I think you bring some uniqueness into the precious metals markets insofar that not only you're very experienced, but you have actually a very colorful background when it comes to investing. Perhaps just if you want to describe a little bit your evolution of investing. I think every investor has some kind of an evolution, at least that's my sense. I think that's helpful for our viewers to just kind of get a grip where you're coming from. And I think your background, I would like to come to that later, could be very interesting when it comes to this exact macro situation where we are when we think about tech, when we think about valuations in technology equities and valuation in precious metals and precious metals equities.
Well, you're right. I do have an odd background. I started as a tech guy, and that was because I grew up in really the Silicon Valley of the Eastern United States, where I was very young in the 20s. I was investing in the mini computer craze, which was Wang Labs, Prime Computer. You may not know all of these names. Cullinan Data Systems, Digital Equipment. They were all the hot stocks of the day, and I found out that you can make a lot of money in tech if you're in them at the right time, and I did. And I spent 20 years as solely a tech guy. What changed really was the central banks. They really started with Greenspan in the late 1990s when he was intervening in all the markets after all the various declines, the long-term capital and the Russia crisis. And then there was the created crisis of Y2K, the non-crisis that they were reacting to then too. And we had a long period of easy money. And what happened was that in my world, it went crazy. It was insane. We had the great tech bubble of the late 1990s and into 2000 that then crashed. And that was no surprise to me. I was long right up through the very end. I owned Y2K stocks. They were the last ones I owned. I sold those, I think, in late 1998. Didn't participate in the tech part in 1999, which is very difficult as a tech guy. But I knew it was a great bubble, and I knew it would crash. I was using options then, put options against that. They didn't work in 1999, but they did work afterwards, thankfully. When that bubble then crashed, as I anticipated, I knew then that tech was going to likely be, when you have a great crash like that, out of favor for a long time. And so I said, I needed to be in something else. As that tech bubble was getting crazier because of the central bank actions, I bought my first gold coins in 1999, I guess it was. So you can't call me a gold bug originally, that's for sure. I never even owned any. So in 1999, I started buying in the $250 to $300 range. And then later on in 2002, I started buying miners as well. And I realized, and I actually wrote in my 2002 in the summer sometime, I think it was around August or so, I wrote to my subscribers and I said, I'm making a big position, putting a big position in the metals now, because I have to protect myself against the central bank debasement that I thought would occur, easy money, and all the deficits that the US were accumulating. And so I did that. And so I've had 1 foot in tech now and 1 foot in gold ever since. This last 20 years, I've been primarily invested in the mining area. I would dabble in tech when there was value. So in October 2002, I bought a bunch of tech names, a dozen or so tech names. In October 2008, I also bought tech names. I should hold on to some of them longer. I held on to Microsoft for 4 years, but it didn't take off until like the 5th year. And I would get involved in various ones, but my primary positions were the metals. Now, this all worked out very well for me because in the first 20 years, I was benefiting from the great bull market in stocks and tech from 1982 all the way on to the late 1990s. And then we went into the last decade for stocks in 2000 to 2010. So it was the right thing to do to get out of them and not be so heavily involved. Now, I was when they were cheap, but for most of the time, I was mostly out. And I thought also that gold would do well in a period when stocks did not. That's the history of it. So in the 1970s, we saw that gold does very well, stocks didn't. In the 80s through 2000 period, stocks did, it was a great bull market there, and it was a great bear market for gold. So it's a yin and yang kind of thing between tech and gold, for me at least. And so it's worked out very well. So what I could never imagine in 2000 and 2002 was the extent of what the central banks would end up doing. I mean, since 2009, the Fed has increased their balance sheet by a factor of 10 times. I never thought we'd have QE 1, 2, 3, 4, and trillions upon trillions of dollars and a couple of $1 trillion in 63 days created as they did in 2020. So the debasement only got worse and worse and worse as each of the attempts to stabilize the system created more problems, more malinvestment, and another bubble and another crash. And this has gone on up until now. And I think one of the reasons why it was okay for them to do that is that they never had to deal with inflation. They had asset inflation, which they liked. Everybody likes asset inflation, but they never had to deal with serious consumer inflation. And finally, we began last year at 1%. And then 1.4% or so, and then we went to 5% by mid-year. And at that point, it was so-called transitory, and then 7% now. And 7%, you lose half your money in 10 years. So that's real serious inflation. It's the worst that we've seen in 40 years, and so that has now forced the hand of the Fed finally to do something. And we're going to get them to a moment of truth here, I think, finally. Where the Fed's going to have to choose. They're going to have to choose whether to, because I think inflation will continue to be at higher levels than their 2% target rate for a lot of reasons. We can get into those later. But I think they're going to have to choose between letting inflation go or letting the stock market go, one or the other. And they haven't had to really make that choice up until now. So this is a fascinating time. Basically, we're back into another bubble. Well, not basically, we are. Jeremy Grantham, the great bubble historian, called it one of the great super bubbles, and the others being 1929, 1989 Japan, and then the great one in 2000. Now, that bubble in 2000, I thought would be the greatest bubble I'd ever see in my lifetime, but it isn't, because this one is. So we're, on a price to sales basis, for example, you're 35% above where we were in 2000. On a market cap to GDP, we're even higher than that versus 2000. And the only thing that wasn't the same was price to earnings ratios, where Schiller PE went as high as 40, and we were 44 in 2000. And the only reason that happened, because I think it would be a lot higher than that 40, is that the companies have gotten cute and they've done a lot of financial engineering where they strip out all kinds of costs, they strip out stock-based compensation, they strip out amortization of intangibles, which I think is a crime, because when you're a software company, you're buying other software, and that's your primary business. You should be writing that down, but they're not taking those costs into the P&L. So the PE ratio would be far higher, I think, than 2000. So we're back in another bubble, bigger than before. I say the bear market began just as the 2000 bubble began in March, but the whole market didn't break down till later. Here again, we had, I say the bubble broke with all the crazy stocks in February 19th of last year, but the S&P continued on. And the S&P, right up to the year end. S&P was up 27% last year, and now it's only been in the last 3 weeks, now that we're getting close to Fed rate hike time, that the markets are starting to really get crunched. And it's crazy stuff as we've seen day to day right here. So this is a big moment. Markets are not liking the Fed rate hikes. They don't like the fact that QE is ending. Whenever they've tried to end QE in the past in past times, the various other ones, it didn't end well. You've had market turbulence each time. So the market's already anticipating trouble even before they've really started much. I mean, they're involved in the reduction of QE. And then they're also talking about reducing the balance sheet. I don't think they'll be able to do any of that. They haven't been able to do it in the past. So they'll come to this moment where it's going to be decision time. What are you going to do?
I mean, Fred, that's obviously the big question, and Dave Rosenberg had some really interesting stats regarding the household ownership of equities, and
record levels.
That's at 45 trillion. That's higher than ever. That's basically twice the size of the U.S. economy, and the long-term average, I think, was 14 trillion. A decade ago, the household sector sat on 12.8 trillion of equities. So to me, that suggests that like a 20% drawdown in this cycle would feel like normally like a 60% plunge. So basically 3 times tougher than a normal correction. But that also implies that the Federal Reserve will have to back down and to make the U-turn even quicker than usually. And I assume, Fred, that you're not really in the team transitory. So you also think that inflation is much more sticky than mainstream economists would suggest. But just one chart that I thought was really interesting. It's by 314 Research. I found it on Twitter. And it answers the question if the Fed really will keep hiking if the market sell-off intensifies. And it says history argues no, because 71% of all Fed hikes have come when the market is within 6% of its 12-month high. So only 18% have come when the market was down 10% or more. So actually that's the big catch-22. I think over there at the Federal Reserve, the plunge protection team is pretty nervous at the moment, probably. So what's your take? Is there any way out for Jay Powell and the Federal Reserve without losing the last tiny bit of reputation and without losing their face, because of obviously Jay Powell tried to sound much more hawkish recently, because he said that inflation perhaps is not transitory anymore. So is there any way out for Jay Powell and the Federal Reserve?
There's a way out. None of them are easy. I mean, as you mentioned there, if you go back to 2000 again, I was in my mid 40s, then early 40s, and I'm in the middle of the bubble. I mean, the baby boom bubble. And when people lost all their money back in 2000 to 2002, there was a lot of time then for people to catch up. Now the baby boom bubble, they're my age, a little bit older, and they don't have the time to catch up, to rebound like they did. Yet, what's happened is that because the Fed has been so aggressive, they took rates to 1%, which was an historical low in 2000, after 2000, but then they went to zero. They've maintained it at zero, and when you do that, there's no way bonds don't become an attractive. That's usually your safe haven. You can't. Usually an income generator, you can't go there. There was no alternative to stocks. That's been a problem. So you have all kinds of people that have taken risks that they not normally would take at their age. and they're very much dependent upon the stock market maintaining these kinds of levels. They couldn't take a huge loss. They'd be financially devastated. So the Fed faces that. On the other side, of course, they're losing credibility. And so they're in a very difficult situation. They really are trapped. I suspect every step that they've taken up until now, whenever the pressure is on, is to support the markets. And I would guess, unfortunately, because I think longer term, that's a bigger problem, because you could lead to high inflation, even higher than we have today. And I mean, heaven forbid, you might see some sort of hyperinflation if this continues. They have to stop at some point. At some point, they have to let the markets go. I doubt it's now, but we'll see.
Let me jump in here, please, because I think what we saw the last few cycles, I mean, for instance, looking at 2006, 7, 8, the consumer price inflation was elevated, not as high as today, but it was elevated. And I think, okay, situation was different, but to some extent, the Fed was a little bit bailed out by the asset price deflation. They pricked the bubble, if it was a bubble back then. And so this asset price deflation also came back to, I think, to some extent, to falling consumer prices again, or at least disinflation, CPIs going back into a range where they felt comfortable. How do you judge this time? Could this happen? Because if we see in this over-leveraged economy and asset prices, when they should they come down very rapidly, do you think, how would the repercussions be on the consumer price inflation?
It depends on how far the market goes down is one thing. I don't think they'll let them go down that far, but so if you lost 80 or 90% maybe, and you had a Great Depression. But I think a lot of the inflation right now is sticky. You can't let inflation go. Henry Kaufman's warning about this. You can't let it get out of control, but then it becomes very difficult to put it back in. And if you look at oil prices now, well, that's a big driver of inflation. And capital investment in oil peaked in 2014, and after oil went down to zero in last year, or last year plus. When that crashed, they cut capex, 35%. They all slashed. I'm involved in all the majors, Exxon, Chevron, ConocoPhillips. I own them all. They're all cutting capex. They're all planning to keep production flat at best. And yet demand is going to still be there. It's going to take a long time for the electrification of the cars and everything to have any kind of real impact on the global demand for oil. So I say oil prices, they could easily go higher here unless you have a real serious decline. But I don't think they're going way back down like they were. Wages are now up. I mean, we went a long time when we went, from 2009 on, basically the stock market went straight up. And we created the greatest wealth inequality the country's ever seen. And finally, once COVID came around, it was time for labor to start getting their share. And politicians wanted to do that as well. And there was pressure to get the money down into them. And we've seen, as we saw, the $1 trillion packages to get money to people. And now we have a wage price spiral going on, where you can see where the higher prices are leading to demands for higher wages. I just don't think that you can, with the wealth inequality that we've had, that's going to be put back into the box either. And then you have food, which is another key part of inflation, and we have a fertilizer problem where prices have soared, and energy costs in Europe, some cases for natural gas up 10 times, but certainly the rest of the world 2, 3, 4 times. And there's talk of shortages of food potentially in the world over the next couple of years. So I don't think food prices are going down. So if you take all of these pieces of, I think some of the COVID related, you'll see a reduction in just the year-over-year decline. I hope so. Some reduction just because of the spike that we saw. But I have a feeling they're not going to be able to get inflation down like they did when the bubble in the 2008 timeframe happened.
Yeah, think so too. I mean, I think perhaps on the macro view, I think it's very interesting to observe what commodity prices in general are doing, and especially in reaction to risk-off sentiment. And so far, I think generally commodity prices have been holding up very well relative to equity prices, which is already significant. Could be a start of a significant change, which brings me to my next question. We often hear, I think, right now from the great rotation. I don't know if you have read this, if you also think that this is going on within the equity markets. What are your thoughts on that? Is this something which will continue?
When the tech bubble broke in 2000, we had one of the greatest value periods ever. From that, in the first several years, value stocks did very well. Commodity stocks did pretty well. They're part of the value group, and we've already seen this. Really that started last year. That rotation began. Now it's been in fits and starts, but we saw the market shift from the high growth stocks to the value stocks, and that's one of the reasons why I'm in energy too, because they were as cheap as anything. Well, when I bought them, they were ridiculously cheap. Something I'd never seen in my lifetime was so cheap. And so I had actually shifted in 2020 when gold had gotten a little bit spiky there, went to that high of 2065 or so. I had taken a chunk of my money out of the gold area and put it into energy. But there are other areas as well. I mean, I'm also in some communication stocks. Verizon's paying a 5% dividend with a 10 PE, for example, and they just reported today good numbers again. But all of these are cheap. Banks were cheap. So a lot of the institutions I know, hedge funds too, we're talking about making this shift from the very overpriced tech stocks to the value stocks, assuming that there would be another big shift. They happen. Over time, value stocks outperform growth over history and over long periods of time. But there's can be a decade or 2 decades where growth will outperform. But when they were that crazy as they were, and right up until, I mean, Apple just peaked in 3 weeks ago on like at a $3 trillion market cap, and it was $1 trillion in 2018. With a 33 PE ratio for a 2% grower this year on earnings, insanity. So institutions see that, they're making the move. It's been in fits and starts, but it's when this thing happens, it usually goes on for years.
Fred, I mean, another interesting characteristic of these crazy markets is that the S&P is basically it's kind of behaving like the biggest stocks and less like the average stock. And we all know that underneath the surface, the market structure was already very, very weak. And I think you gave a terrific interview for Neue Zürcher Zeitung, The Market, when you warned that exactly about this market structure, this market internals that are already weakening. So I think that what is the number? Like half the total return in the S&P 500 last year basically came from 5 stocks and
all my tech stocks.
Exactly. So as the S&P, as the general market, as most people would say, is behaving like these couple of tech stocks. I mean, that basically means that having more exposure to the larger stocks will benefit the index when those stocks outperform, as it has been the case. But it can also negatively affect returns if they begin to underperform. So obviously the big question is, will the leaders of today be the leaders of a decade from now? And what is it going to mean for the S&P? And if we compare, I think the market leaders, so the biggest companies from 1991 to today, we can see that there's basically no overlap at all. So from your point of view, of course, I mean, this is all a consequence to some degree of of the whole ETF mania that we're seeing. But from your point of view, how might this end? I mean, obviously, I think we both agree we should, in this environment, de-risk portfolios, probably shift up in quality, move into more defensive and lower beta stocks. But would you regard this setup as an opportunity, or do you think it's more of a threat? Because I think that most people don't have a clue that the Russell 2000 is probably trading at significantly lower levels than at the beginning of 2021. So this is kind of this, let's say, Potemkin village where people think the market is doing okay. Of course, now there's a correction, but underneath the surface, it's already tremendously weak.
It happens every bear market. Back to 1990, the tech stocks, the big cap tech stocks, and at that time they were Compaq, Intel, Microsoft, and Oracle. They were the four favorites. They held up until the very end, and then they fell between 40 to 60% in 3 months. That was the end of the bull. When that happened, that was the end of that bear market. You go back to 2000, tech stocks broke in March. The investors then shifted over to, they said, well, the internet's still going to be a big thing, even though the dot-coms are, kind of crazy. I won't invest in them anymore. That was in March. They held up all the way through. By the end of the year in 2000, the Janus funds, for example, every type of fund they had, from value funds to small funds to large growth funds to dividend funds, are all in the same four stocks. They all own Cisco, Nokia, Sun Microsystems, and EMC. They rotated them. In December of 2000, I should say, John Chambers told everyone that he was never more bullish. And then 3 months later, he was laying off like a quarter of his workforce. It takes time for these. They say bear markets are a process. They are, and bull markets are a process too. They both are, really are. Those stocks then crashed, and none of those four stocks that I mentioned ever came back. Intel was the first one to crash. It crashed in Labor Day from 70 to 40, boom, and then into 2001, Cisco fell 90%, EMC and Sun fell 96%, and Nokia fell something like 90%. Tremendous losses, but it wasn't until later. And even then, into 2001, the S&P was holding up a bit, and it wasn't until 2002 that everything really got crushed. So it's just the way it is. People become enamored of these tech stocks, and they don't lose faith right away. They rush into what they call the safe havens, and what are they doing? They're calling Apple a safe haven now. It's a safe place to be. Well, it's not a safe place to be. You can't justify the PE ratio. And what we have now in the tech world is not only do we have valuations that could pop and crash, as typically happens, but we also have trouble. I see trouble on the horizon economically. Now, if the stock market declines a lot here, and I think it will, before the Fed can even react, it's going to have an impact on economic activity. When 2000 tech bubble crashed, it had an economic activity because there's all this malinvestment in all the dot-coms. And today we've had all this investment in SPACs, and we've had record IPOs and NFTs and digital virtual real estate. Well, those all are companies. They all got funding. They all have jobs. And when that stuff starts to crash, so the economy does too. The other problem is we had such a sugar high in 2020 when the Fed printed as much money as they did and handed it out to the Treasury, handed it out to people, that and also there was a stay-at-home, work-at-home factor there, which inflated all of the tech companies' numbers. So they were these big cap tech companies were huge beneficiaries of COVID and of the money printing. People were forced to stay at home, and what do? They spent all their time on computers and iPads and smartphones and entertain themselves, and that's all they could do. And when that happened, well, some examples. The PC market had declined for 7 consecutive units. From 2012 to 2018, 7 consecutive years. It was considered to be a dead industry. Well, it went back up into the teens here growth. It was 2020 and 21 were in the mid-teens kind of growth. And a year ago at this time, we were seeing 50% kind of numbers year over year. So we had this explosion in activity. For Apple itself, Apple had been growing at 2.7% compounded from 2015 to 2019. It grew 33% last year. Why? Well, smartphones exploded. That had been a saturated, stagnant market. That went up to 25% growth. And in the Mac side was up 70% last year after being flat. Their iPads were up 79%, just huge increases where they were jumping a year ago. So all of these companies, Amazon was obviously a big beneficiary because everybody was buying stuff and having it shipped through Amazon to their homes. Google, Meta, if you want to call it Facebook, whatever, they were beneficiaries. People were watching YouTube, they were, Instagramming, they were doing all that kind of stuff. You take almost every one of those companies. Microsoft is a big PC company still. You take every one of them. NVIDIA, which is a gaming company, people were gaming. That's what they were doing. You take almost every one of those major tech companies, and they all benefited here. And that was one of the reasons why their numbers were so fantastic. That's how you get an Apple with a 33 PE. They were growing at that level, and now they're growing at nothing. So the analysts are now estimating that Apple's they're not going to have any back to single digit growth, and they're too optimistic because this year I think it'll be negative. I mean, when you look at the numbers they're going to be comparing against in the last quarter, first quarter of last year, it's just dramatic. And there's no way, I don't think. I mean, even though Apple went to a record high at the end of last year, people had forgotten, I guess, who had short memories back then, that Apple did not give guidance. They refused to give guidance because things were too uncertain, and they're going to remain uncertain. They may not give guidance here again. I think this quarter's numbers will be okay, but when the comparisons the first half are just going to be dreadful. So, NVIDIA went up 10 times in 3 years, 10 times. It was a semiconductor company that had an $800 billion market cap. I've never seen anything like it. It had 100 PE on those peak earnings. It was selling at 35 times sales. I had never seen, in the bubbles in the past, I saw NVIDIA go at 35 times earnings, not 35 times sales for a cyclical semiconductor company. More insane than anything I've ever seen, but it's not just a little company. This is not .com. This is an $815 billion market cap company. And so now what's happening? Well, video game sales are declining. PC sales in this last quarter were just put out by Gartner. They fell 5% year over year. 24% decline year over year in the US. So NVIDIA depends upon PCs and gaming consoles. That's their primary business. They have a few other businesses too, but that's the primary business. How are they going to maintain that? I don't see these tech companies holding up earnings-wise, no matter what happens here in the economy. But if the economy turns down, and we haven't had a real recession since 2009, I don't count that 1 month recession, in 2020 to really be anything very painful. But we have a real recession here. I think we'll have to. We're due for them, certainly. Then that alone would hurt them. But then you see all these numbers from these tech companies that drove their valuations, they're not going to be here going forward. So it's a real problem going here.
I think Ronnie and I are enjoying your passion. So just perhaps we can switch gear and also tap into this same kind of passion, but perhaps in the other side of the direction. What happened to gold? I mean, Ronnie wrote a nice piece why gold lost its mojo, or if it has lost its mojo. I think it was a big disappointment for a lot of investors last year, 21. And more importantly, what will happen?
Can you see the slides, gentlemen?
Yes, I can.
Yeah. So, Fred, I think that that describes it pretty well. I know many people who thought, well, now that inflation is really a topic, gold should be taking off, and we wrote our special piece called Inflation and the Boy Who Cried Wolf, and we published it in December 2020 when the CPI in the US was at 1%, and 1 year later it was at 7%. But still, gold didn't really perform as expected. So what's your take on that? As we can see here at the moment, it seems that gold is now really one of the most hated assets.
It certainly is. But I love it when I see these kinds of headlines, of course. Usually means good tidings. Again, I want to go back to 2000 where gold was hated after a 20-year bear market. And when the tech bubble broke, all the money was going into tech at that time. It even wasn't even going to much else in the stock market, just all of it into tech. It was sucking in all the money. And gold, even though the market started to crash in 2000 and then into 2001, gold didn't do anything. Gold was up 1 year by 2%, down 1 year by 5%. I know I looked at the basically ended up almost unchanged over those first 2 years in 2000, 2001. It wasn't in 2002 that gold started taking off. Well, why is that? Well, I think it's because when all that money goes into tech, they don't give up easily. What did I talk about earlier? They shifted from one tech company to a safer tech company. And so it takes time for that shift to occur. And what have we seen here? We saw just from March 2020, the last year and a half or so, we saw those 8 tech names go from $4 trillion to almost 12, if you include Tesla. Almost $12 trillion worth of market valuation. All the money from institutions was piling into these names, just as they did in 2000. And it wasn't just in the US, it also was, I believe, also was a lot of international money that was chasing, because there was no way to make money anywhere. Yields are negative or zero all around the world. There was no place to make money unless you were in these high growth techs. You were always going to underperform unless you were in these small number of techs. And so it takes a while. That's why I talked about the lag time. They always get crushed at the very end. They shift into them. And so gold right now, when everybody shifted into those tech names and their earnings were great and everything else during the COVID times, then there was no interest in gold. It peaked. I mean, there was at first. Had a nice run there into 2020, where it went to that 2065 peak or so. But after that, all the interest was in the tech names, and I think that's just changing. I mean, as I mentioned, Apple's only down for 3 weeks now. It hit a high of 182 just 3 weeks ago, and last I looked, it was 150 something. It's come down some, but it certainly is beloved, and people were calling it a safe haven 2 days ago. So. It takes time. I think as this bear market evolves, then gold will do well. Now, everything's in place for gold to do well. Obviously, we have the deepest negative interest rates, which is a key driver that we've seen in, I think, 70 years. They're even deeper than they were than the high in the 1970s timeframe. It would be nice if the dollar started to decline, and in theory it should. One of the problems is against the euro, and they're almost as bad or worse than we are in many ways. But certainly against the Asian currencies and others, I think the dollar will decline given all our deficits that we have. Usually gold does well with huge deficits, and we've been running $2 to $3 trillion budget deficits, and we're gonna, in another week or two, we might hit $30 trillion of US federal debt. These are all propellants for gold. So gold should do well, but I think it's just been held back by all of the focus that's been on tech. And the S&P was up 27% last year, right? That's only 3 weeks ago.
And as we can see on this chart, I mean, volatility last year, I think we saw 17 new all-time highs in the S&P, and realized volatility was the lowest since I think 2017. So actually no need to have a portfolio hedge. But I think, if we take a step back, I think that gold basically sniffed out that something's happening already in 2019. So in US dollar terms, it was up 18%. It was up 25% in 2020. And then, of course, last year it was a bit disappointing, minus 3.6%. But still, given the fact that it was up 18 and then 25% the 2 previous years, and basically, 2018 it was basically flat, and 2016 and 17 it was also up. I think that's quite okay, because we shouldn't expect any, Bitcoin-like performances from gold.
No,
And
I
and
mean, yeah, gold
as,
was
as,
at
as we can see here,
Mhm.
thanks to Madame Lagarde over there in Frankfurt, in euro terms, gold did pretty well last year. It was up 3.6%. So
Mhm.
our take is that gold has been kind of sniffing out that real yields would take a dive already in late 2018, and basically discounted already quite a lot of those developments, and especially the surge in inflation. So I think that, given the fact that gold is really something special on every continent, in every culture, in every religion, I think that the discounting mechanism of gold is superior to most other traditional assets. So the collective wisdom of the price of gold might be a little bit ahead. But I think one thing, Fred, that the market is discounting now. I think the market agrees to us that inflation is a topic now, but the market, or for example, break-even inflation rates, they're not seeing inflation as a long-term threat. So from your point of view, what's going to happen if that narrative will change, and when will it happen? Because I think our roadmap kind of is that, due to the base effect and everything else, CPI numbers will come down, at least slightly, and this will give some leeway to central bankers. But then I think markets will realize that it's much more sticky than they believed, and I think this might be really the breaking point when also those long-term inflation expectations might shift.
Yeah, I mean, no question. You mentioned, just to go back, you mentioned, I mean, gold was at 1180 in 2018.
Yeah.
It doubles almost. It doubled. People have no patience. What we
Yeah.
saw was very normal. We had a spike up in 2020 to the 2065, and to not expect a correction after that would be foolish. But so it's happened. It's gone on. If you're a technician, the technicians love it. You have one chart I know that shows the cup and handle.
Mhm.
For gold that it shows a perfect 10-year cup and handle, and now we're into the handle. And after that, gold should be taking off. I think, inflation has only been around now, right? I mentioned the timing. It was 1% a year ago, and it was 5% in the middle of the year. We haven't had high inflation for very long, so it takes some time for investor expectations for inflation to grow. But as inflation, I think, doesn't come down back below the 2% level, and if they're back to forced to defend markets, people are going to see that this inflation will be with us for longer, and then inflation expectations will then rise. One of the other things I noted when you put up the chart of all of the gold through the years for the 20 years was the 5 years that gold declined. Since we started the GLD, were in 2013, 14, 15, 18, and last year, 2021. Every one of those years, we had 1 million ounces or more outflows from the GLD. Now, that's an indication of institutional buying. And we lost from that 2020 top, we lost 300 tons of gold, and that was institutional selling. And we were at, I look back, we were at 980 tons or so into the GLD at the beginning of the year. And so we were still around $1,800 in gold. I look back the last times we were at 980 tons. And it was in 2016, when we were at 980 tons, we were at 1340 gold. And April 2020, when we were at 980 tons, we were at 1,615 gold. And now here we are. So even though the institutions have this very low level of holdings, the gold price has been going higher and higher and higher. Now, why is that? Well, that's because of all this buying from others. We have this massive central bank buying that's been going on, where they've added 4,500 tons, and that doesn't include the Chinese numbers. The Chinese have been adding every month here, even though they haven't reported. I know that. I have good sources on that. So last year in China, India, huge amounts. India was over 1,000 tons combined. They were 2,200 tons. So what's happened is that the overseas buyers who buy when prices are low have been buying, and they've been setting a higher and a higher floor without any help from the U.S. institutions. And part of the reason is because they don't think there's going to be inflation. And so, but when that does kick in, that's usually what drives it. That's what drives their numbers. The gold price is higher when U.S. institutions and U.K. institutions, the Western institutions, once they come in, they're the ones that drive prices up too. They're always buying at the top, and they're always having the lowest positions at the bottom. And so I think it was very interesting this past week when the stock market took a very deep dive on last Wednesday. We saw a couple of things. We saw 5 tons of gold come in, and I said, boy, that's really encouraging, into the GLD. But then on Friday, we saw 28 tons, and it was one of the greatest inflows ever. And that was a day where the market was, obviously it was a tremendously volatile down day. And 28 tons, it was the largest dollar inflow ever into the GLD. Well, this looks to me like the start of U.S. institutions coming in. We've seen that kind of thing before, these kinds of numbers. That's usually been the beginning, and we've had big runs on gold after that. So I think we may have already started. As Apple has come down, well, the other thing to note too is, what did Bitcoin do? I know you guys are a little bit more favorable on Bitcoin than I am, but what did Bitcoin do? Bitcoin has crashed with the markets. It doesn't look like a store of value. Gold has gone up or flatlined during this decline to up, but Bitcoin has lost half its value here, lost $1.5 trillion in a very short period of time, a couple of months here. That doesn't look like a store of value to me. It certainly wasn't. It isn't used as a monetary exchange. What it looks like is another shiny object that people have been speculating in. Now, I know there's a lot of libertarian types that believe in it, and I respect that. But so far, all I've seen is every time the stock market goes down, it did in 2018, Bitcoin crashed. I mean, every time, and we haven't seen a sustained crash here because the Feds always come in. But if they can't come in, Bitcoin fell, stock market fell. Money went into gold. And I think that's maybe the very beginning of this, and that will propel us a lot further.
That brings me to a question. I would be extremely interested since you are covering basically, I think, a lot of markets. You're obviously very bullish on gold, so are we. Could you kind of, would you say is this the sector where you're most bullish currently, or could you give some kind of a scale in terms of places where you're extremely bullish on?
Well, I like value stocks. So as I mentioned, I have some communication stocks. I have some energy stocks. But my primary positions are the metals. They do best. Well, in an inflationary period, I saw Johnny had a chart I had seen earlier this morning. In inflationary periods, the 2 best performing sectors are gold and commodities, and oil in particular. So I'm in gold heavily. Biggest positions I have are in the miners. They're ridiculously cheap, historically cheap. I go back, Huey to gold ratio, which is one of the ones I watch, currently at 0.14. During the 2000s bull market, it averaged 0.46. It would have to triple to get to the same level that we were. I mean, all the valuation metrics of the miners, whether you're talking about free cash flow or dividend yield, the dividend yield is it's over 2% versus 1% for the market. Free cash flow is almost double. The numbers are huge. And one of the reasons is gold's been, underloved here for this past period here of time. And also, when that decline occurred out of 2016, we had a big move. Really, I say the cyclical bull market began at the end of December 2015. But we had that big move. Gold miners went up 100-something percent, and then they crashed that left a sour taste in people's mouths. It was a big decline, and it's hard for them to come back. So one of the reasons for the severe undervaluation is the history, and people didn't understand that as a result of that crash, companies changed their stripes. They didn't they weren't overbuying and overbuilding or anything like that, and they became shareholder friendly, and they've been increasing dividends and increasing buybacks and all of those sorts of things. So that's one of the reasons why the dividend yield's higher and the cash flows are higher. They're all so much better, but it hasn't been recognized yet by the market. It will be, always does, always will be. And when you do get the moves, I mean, in the 2000s timeframe where I was heavily in the metals, the miners, I mean, they went up 17 times. 17 times, 1,660%, unbelievable. And then we've had, when the miners go, they go in big waves. Even in 2020, we had a 130% move. In 2018, we had a 140% move. So, it's a group that goes to Great Depression fears and to heights as well. And we're at this point, things are very negative. I look back at I monitor the GDX and GDXJ every month, the two big ETFs, the big miners and the smaller junior miners or intermediate miners now. And the number of shares outstanding on the GDX currently is 400,000. That's it. And with all the ETF money that's come in, 400,000, that's as low as it was back in 2018. They've had no inflows whatsoever. The GDXJ, I've been monitoring that since 2016. I've never seen it lower at 100,000. So all this money pours in to mostly tech stocks. No money goes in, none, zero. So I expect that to change too. We've had no inflows at all. And again, it shows the institutional lack of interest in gold, lack of interest in the miners. But they will come back in, and so this is a great opportunity. I think one of those opportunities of a lifetime, because I think gold will take off, and we all know that there's huge leverage on the miners' bottom lines, and the balance sheet. The P&L is a fantastic to start. Never mind what they could be with a much higher gold price.
I mean, I think we couldn't agree more, Fred. I attended a couple of conferences last year and the Precious Metal Summit and also Denver Gold last fall. It felt like
I loved it. Empty rooms.
It was pretty empty. There was some good videos and jokes on Twitter about that. But as you rightly said, I mean, having a look at this comparison between the S&P 500 and the GDM index, which is the gold miners index, I mean, it shows that not only relative to its own history, miners are dirt cheap, but also now relative to the general market. And I agree. We are seeing really pristine balance sheets in the sector. We're seeing high margins. Of course, inflation is a topic also on the cost side. But as far as I see, most of the companies really have their cost structure under control. I think the sector managed the whole COVID crisis pretty well. So probably this is the healthiest setup that I ever saw in the gold mining space. But as you rightly said, the market has not realized that yet. And as this chart shows, that's the XAU index versus the S&P 500. This is probably really the biggest anti-bubble that we're seeing. And another one that we always show, because it's just a great chart to understand the big picture. This shows the BGMI, the Barron's Gold Mining Index, which is the mining index with the longest history. It's around since the 1930s, and it shows all bull markets. And as we can see here, this bull market, if we can call it a bull market, is kind of long now, but we are far away from this mania phase that we usually see at the end of every trend. So yeah, it's pretty exciting setup in the mining space. Fred, I don't know if you also cover the silver space. Also probably very interesting. We regard it as some sort of a levered play, some sort of a derivative on the price of gold. So I don't really see miners being able to decouple from the price of gold, and I don't see silver being able to decouple from the price of gold. But if we are in a bull market for gold, I'm pretty certain that silver will start outperforming. So perhaps it's time to talk about specific names if you want to, Fred. I mean, I know that you're big fans of Kirkland Lake. I know that you're like the Golden Triangle a lot. I think you own Pretium, which is being acquired now.
Kirkland too. I'm losing all my favorites.
Yes, Dolly Varden, also up in the Golden Triangle. As you might
there.
know, I'm also on the board
Right.
of Tudor Gold, up in the Golden Triangle, one of the biggest discoveries of the last couple of decades. Yeah, let's talk about your favorite names in the mining space, and also when it comes to the size of the companies. Do you prefer the producers now? Do you buy into the developers? Do you go into the junior space? What's your take on political risk? Yeah, let us know a little bit more about your investment process in the mining space.
Yes. Okay. Well, I'm not a geologist, so I try to stick with what I know. And so I don't spend too much, I don't put too much money into the junior miners, the explorers particularly. However, because I know that they will have the greatest move here. If we're going to get what I think we're going to get, and I think you agree, the juniors will go crazy, as they often do. As they always do in bull markets. And so I wanted more exposure there, and I've been adding to them. You mentioned Dolly Varden being one in the silver area, where it has. But what I like to do is, since I'm not a geologist, I like to piggyback on companies that I respect their managements, and if they made investments in them, then that gets me pretty far to start. And so in Dolly Varden's case, Hecla, one of the largest U.S. silver maker, tried to buy Dolly Varden in 2016 and was rebuffed. Different management, and Dolly Varden's package is surrounded by Hecla, so that's an attractive a miner, and they have an 11% investment in them as well. They've retained that investment. So I also own like Rupert Resources in Finland, because Agnico has a position there, and I also have. Then I think they're the very best management in the gold business, and I also own Maple Gold, and they have a joint venture with Agnico. So you can see what I try to do on the junior side. I try to let the geologists be the geologists, and the ones I really respect. And so I have a number of those. They're smaller positions. Geographical positioning is important for me. It's one of the very first criteria. I start there. I won't be in South Africa. It's just a disaster there. Labor issues are still, they're trying to get labor raises again here, and striking, and the place has been, it's gone from number 1 to number 11 in the world now. And so I don't want to be in there. I don't want to be in Russia. Obviously there are issues with Russia right now. I don't want to be in places where they don't respect the rule of law. We've seen, it's a big problem in silver right now, because the 3 largest areas are Mexico, Peru, and Chile, and all of them have turned leftist. With Chile and Peru just most recently, and they're talking about significant tax royalty hikes there. So you have to worry about expropriation. I don't want to be in Venezuela. So it limits me to a certain number of countries in the world where the rule of law is respected, property rights are expected. That would be the US, that would be Canada, heavily in Canada, that would be Australia. I'd mention Finland, which is one of the highest rated European country. So those kinds of places. Where I try to make my investments. I start there. I also like to have good managements. And since I did mention that Agnico Eagle, I think, has the best management out there, I have a very large position there in one of the senior miners. I have smaller positions in Barrick and Newmont. I think they'll do well. It's just that, their geographical position aren't as good as Agnico. Agnico's mines are all in Canada. They have a small position in Mexico. That's it. Finland. Only in the very best locations. And now they bought Kirkland Lake, also Canada, also in Australia. It's just the best located, best managed, and it's almost half of the price that it was not too long ago. It's really, I think it will be, and Agnico CEO Sean Boyd mentioned, it will be the go-to name, I think. in the space. So I want to own that, and it's cheap. The only problem right now is, just so you know, this is a very good time to buy, possibly because they had to shut down their Nunavut, Canada operations for COVID, for Omicron, because it's so virulent here. And we don't know when they're going to start back up. I think it'll be very short, but it could have an impact on this quarter's numbers. So there might even be another opportunity to buy that one. There's some that are really cheap. As I said, I lost last year because of acquisitions, because some of the majors are seeing opportunities there in these good locations. So Kirkland got bought out, and Pretium got bought out, and Great Bear bought out by Kinross. I also own that one. I lost that one as well. But I own some other ones I do own, and I'm kind of shifting funds into them. One of them is Alamos Gold. It's a very strong intermediate company. Most of their mines are in Canada. Their major mines are in Canada. There's a smaller operation in Mexico. Right now, the stock is depressed because that Mexico operation called Mulatos, the Mulatos mine, is going through a transition. And they're going to be going to a new pit area called La Grande. And when that happens in the second half of the year, starting the second half of the year, the costs are going to crash. They're going to be cut in half. And the production is going to go right back up, and they're going to be hugely cash flow positive for the next several years, on top of their very great mines. Island Gold is a tremendous mine, one of the highest grade mines in the world. So Alamos is great. It's selling at a fraction of net asset value, like 0.7, and a very low PE. Wesdome is another one. That company is supposed to earn, it's also in Canada. They are basically doubling the size of their company. They've had one mine, and now another mine has just started up, and it's increasing their production dramatically. They're expected to increase their earnings this year by 65%. The PE is 8. You don't see these kinds of things unless you're at a bear market low. I could give you lots of other names, but geographics are very important. I stick to juniors where I can have some edge. I like the intermediates that are still out there, and there is a chance for acquisitions of those too as we go forward.
Excellent. I think most of the names that you like, we like as well, and we own for our funds. Hekla and Agnico Eagle are also premium partners of our In Gold We Trust report. It's a great pleasure working with those two companies and two great management teams. Now, Fred, the final question from my side, at least, would be, as your newsletter is called the High-Tech Strategist. I know you are probably. I love reading your material because you're one of the few people, it seems, anymore that really listens to earnings calls, and you're really doing your research. You probably already have an idea when to start buying into the tech space again. We have seen some volatility recently. I thought it was interesting that the Chinese tech space basically started that whole correction already more than 1 year ago, and now some companies in China seem to be at kind of attractive valuation levels. But from your point of view, how much of a further correction or crash does it need for some names that you like in general to start buying again?
If they get to levels that are cheap, I'll buy them. So last year I owned Nokia, and it went up 60% or whatever. It was good. So even in the bubble period, there was a hated stock. It was a turnaround story. So really, that's what I'm looking for. But unfortunately, we talked about these valuations being beyond belief. I'd have to see a really serious decline from here before I was to get very aggressive. Now, I have bought here and there. If I see things in individual industry, there's one I owned last year called Sensata, which is a semiconductor company that was benefiting from autos. I think it was in 2020 I started buying it. But I'm looking for valuations to come down, or if the Fed comes in and pours a lot of money in. And if that happens, and I see, then I could be buying again as well. One or the other. It has to be valuations, and we're nowhere close. I mean, we're just at the beginning of the breakdown of the large cap stocks. even though, and I'm not interested in buying the garbage that fell apart, all that stuff that fell apart starting in February. That's not my kind of thing. I buy quality. And unfortunately, I like software companies and their margins and everything. And, those have been crazy valuations. But if I see them coming down, then my antenna's going up, because I am the high-tech strategist, and it's hard to get take all the criticism because I'm not talking about tech. So there's some pressure on me to be looking to buy.
So you don't feel like a kid in the candy store in the tech
No,
space yet?
no,
I think you said that recently in an interview.
No, we're at we're at the 2001, early 2001 time frame here, and in the bubble. Only the crazy stuff is broken so far.
Yeah, I couldn't agree more. Mark, do you have any final question?
Yeah, final question, Fred. Crystal ball, when new all-time high in gold?
Yeah, I try not to put out targets. A lot of people put out target prices, and they also put out those kind of forecasts. And I just know that the setup is perfect as far as I'm, whether technically or valuations or negative interest rates and the tech part falling apart. It's perfect. So I can tell you they're going higher. When exact, I'd say this year for sure, because I think things are going to fall apart. But when, it's hard to know. You mentioned that inflation might come down a bit. It might, and that could have an impact. You could seasonally, we're in a strong seasonal period for gold right now through February. I think we could do well through February, and then maybe have another dip. So it's hard to know. It doesn't really matter from my standpoint, because I'm a long-term investor and I'm looking for a big payoff here in this area.
Brilliant final words. Thank you so much from my side, Fred.
Absolutely, Fred. Thank you very much. I read in your most recent piece lots of Ludwig von Mises quotes.
Yeah, I'm an Austrian at heart.
So we are Austrians from Austria. So one of them, I actually didn't know that quote, where you said, or where you quoted Mises saying, what generates the evils is the expansionist policy. Its termination only makes the evils visible. This termination must at any rate come sooner or later, and the later it comes, the more severe are the damages which the actual boom has caused. Wise words, and I think they are, yeah. I mean,
they really apply today, I think, unfortunately.
Absolutely. So Fred, is there anything you want to say at the end to how can our viewers subscribe to the High-Tech Strategist?
Okay, if you want to get details on the newsletter, you can send an email to the High-Tech Strategist at yahoo.com. That's THEHIGH strategist as it's spelled. High-Tech Strategist at yahoo.com.
Thank you very much. Fred, you're also very, very active on Twitter. Really like your comments. So thank you very, very much for taking the time. You've got many, many fans and followers over here in Austria, and that's an open invitation to you and your wife. If you should come around, please let us know. We'd be happy to show you around and to do the Austrian economics walk here in Vienna, and to have some good schnitzel, beer and wine, whatever you like over here in Vienna. Fred, thank you very, very much. It's been a great pleasure finally meeting you. Here. Thank you very much. Thank you.
Bye.
All the best.
Take care. Cheers.
Yes, bye.